let's talk about income taxes. If you want to take a moment to read what's typed in blue here, it'd be helpful. Go ahead and pause it. And let's go on. Okay, our first example says here, Karen earned wages of $38,200, received $750 in interest on a savings account. She contributed $1,200 to her retirement, and she qualified for a personal exemption of $3,900 and a standard deduction of $6,100. We want to know what's her gross income and her adjusted gross income and taxable income. Okay, so when we talk about her gross income, we're going to talk about her total income, total amount she received. So in this case here, her total amount is the $38,200 plus the $750, and that gives us a total of $38,950. Now on the AGI, you're going to take the gross income and you're going to subtract the adjustments. So the adjustment is going to be the $1,200 that went towards retirement. So you got the $3,800 or 30, sorry, I keep saying $3,800. I mean $38,950 minus that $1,200. And it's going to give us a total of $37,750. Now let's figure out the taxable income. The taxable income is the AGI, which the AGI is the adjusted gross income minus the exemptions minus the deduction. So we got an AGI of $37,750, exemption of $3,900, and a deduction of $6,100. And by the time we're done with that, we have a total of $27,750 that is taxable. So that would be the part that you go to the tax table to determine how much should have paid towards taxes. And sometimes you overpay and you get a refund. Sometimes you underpay and you have to pay in. So let's do the next example right quick. Marie earned wages of $20,400, receives $95 in interest for savings account, and contributed $1,200 to the IRA, the retirement. And I apologize, it didn't really say IRA, it's just retirement plan. And she has an exemption of $3,900 and deductions of $61. So let's figure out her total gross income. We're going to take that $28,400 and we're going to add the $9,500 to that. Or it's not $9,500, my apologies, $95. So now it's going to be $28,495. The adjusted gross income, we're going to take that $28,495 and let's subtract that $1,200 that went towards retirement. And we got a new AGI of $27,295. Now the taxable income, we're going to take that $27,295, subtract that $3,900 exemption, the $6,100 deduction, and got a total taxable income of $17,295. So now let's go to our next example. Our next example says, oh, okay, if you want to take a minute, let's talk about this part here. So you got single, which is unmarried, divorced, or legally separated. You got married filing joint, so you're married. You can file that way. Married filing separately, you're still married but not together. Head of household, you are a single person with a dependent. As of 2013, exemptions was $3,900 per person on the tax form. Standard deduction is, it goes up each year, so is the exemptions. But the standard deduction is what you get single, married, or, either one of these categories. You'll get a different amount depending on the category you fall in. But that's across the board. Now, if you want to itemize, because you have the option between standard deduction and itemizing. Itemizing is if you have enough out-of-pocket expenses that qualifies that exceeds the standard deduction, then you get to use it. So what am I talking about? You got mortgage interest on your home, you got out-of-pocket medical expense, charity. There's a list of things that you get to use that will qualify for itemizing, but it has to exceed a certain threshold before it becomes qualifiable to use. And if it doesn't exceed that threshold, then you're going to stick with the standard deduction. Example 2 says, suppose you have the following deductible expenditures. You have $2,500 in interest on a home mortgage, $900 on charity, $250 on state income tax, and you have a filing status of standard deduction of $6,100. Should you itemize your standard deductions, or should you itemize, or should you claim the standard deduction? So what we want to do is let's add this up. So we're going to add up the 2,500, the 900, so the 2,500, the 900, and the 250. Now, if it exceeds that 6,100, then yes, you're going to itemize. And when we add these up, we get 3,650. So you're not going to itemize. You're going to stick with the standard. Okay. So let's talk about our next example. Our next example says your deductible expenditures are $3,700 for contributors to charity, $760 to state income tax, and then you got standard deduction. Which one is the best option again? So we just take that 3,700, add this 760. Does it exceed the 6,100 threshold? And no, it doesn't. So we're going to stick with that standard deduction and use the 61 instead. 6,100. I keep saying just 61. Guys, take a minute. You might want to take a picture of this or whatever, because we're going to go back and forth to this. I will probably scroll back and forth between screens on this next part. So let's talk about what we got going on here. We have this tax table, and of course, this is from 2013. It's way different by now. The numbers has changed quite a bit. And if you notice here, we have the tax rate column here, and I'll give you this information as we go as how it actually applies. We have a single column, married filing jointly, married filing separately, and head of household. And if you notice at that year, the exemption per person on the form is still $3,900. However, the standard deductions change depends on the circumstances. Okay, so now let's go back and let's solve the first example. And like I said, we'll probably have to go back and forth so I can help you better understand this. It says now on this first one, it says use this tax table to calculate the tax owed by each of the following people. This first one says Megan is single with no dependents. Her adjusted income is $90,000. So that is her adjusted gross income. And so she is single. And if she is single, then she qualifies for the 6,100, right? Right here. So what I'm going to do is say, okay, her exemptions, her taxable incomes, what we got to find out first. Before I can tell you what she owes on taxes, we need to figure out her taxable income. Let me scroll. I'm trying to make it where we can see the screen. Okay. So she's got income, a gross income of $90,000. And we're going to subtract the 6,100 and a 3,900 exemption. So these are the two things she qualifies for. When we do that, our taxable income becomes $80,000. All right, so let's talk about this $80,000. How do we determine her taxable income here? By using this chart. Let's look at it. It said 10% up to 8,900 or 8,925. Okay, sounds better that way. So what I'm going to do, let me change this right quick, is I'm going to set this up right quick, right, in a certain format. So we got 10%, right? times, I'm gonna use an X, 8925. We're gonna add that to the next portion. 15% times, and it's up to, because she's single, right? $36,250 plus, now we haven't exceeded this yet. She comes up to the 25% bracket now. Oof, that's scary. Times, however, she didn't go up to 87,000. She only went up to 80,000. So in this 25% bracket, we need to figure out the difference. So I'm going to take that 80,000 and I'm going to subtract. Oh, and I skipped a step. My apologies, guys. Please forgive me on this. Kind of got carried away. Sorry, guys. So just know that we all make mistakes. You don't have to erase everything on your paper. Please don't. There's part of this is correct. I'm just going to write it right here because I need to see it better. Okay. At that 15% bracket, right? It says the 15% says 36,250. I got to subtract that 8925. Why? Because it's already been taxed at 10%. So you don't want to do it again. So we're going to subtract that difference. Now let's add it to the 25% bracket that she fell in, right? Times, now she only made 80,000. That's taxable. So we're not going to write the 87,000 because we're not going to tax her on the $7,850 she did not make, or that was not taxable on her part. So we're going to write the 80,000 that we calculated here, but we're going to subtract that 36,250 because that was taxed at 15%. So now, let me change this out. Now let's rewrite this. So I'm going to rewrite 10% as 0.1, and we're going to multiply that to 8925. We're going to add that to 0.15 times the difference between 3,600, because we got to take that 36,000, I keep saying 100, guys, my apologies, 36,250 minus the 8925. The reason why is, again, $8,900 or $8,925 was taxed at 10%. You don't want to turn around tax it at 15 too. So now you have 27,325. I'm going to add that to the 0.25% times. Now the total amount that was her AGI is 80,000, or taxable income, not AGI, her taxable income. We're going to subtract that from what was taxed previous at 15%, which is 36,250, and now 25% of her income, which is that 43,750 is taxed. Now, I hope this makes sense. So this is something you got to practice at. So now let's add all those up, do the multiplication. All right. So now we have a new set of numbers, right? This here is going to tell me Megan's tax that should have been paid. Should have been withheld for federal. It's $15,928.75. Okay, that was based on 80,000 taxable income. Okay, let's do another one just for a good practice, okay? And then I'm gonna let you do the last one on your own. Okay. Robert is head of household, taking care of 2 dependent children. His adjusted gross income is $90,000. Okay, so now we need to, let's go up here. We need to go and look at the standard deduction, and we need to look at the exemptions per person. So, oops, let's go up. Head of household. What is head of household? It's this last column. All right. So at this time, the standard deduction is $89.50, and exemptions of $3,900 per person on the tax on the return. So I'm going to take this $90,000 and we're going to subtract the $89.50. I'm sure I remembered that right. And I did this a little bit early. Well, we can go ahead and do that. Let's just subtract. Let me write it different. Subtract the $89.50 minus 3 times that $3,900, right? Because it's him and 2 dependents. And that gives me a total of $69,350 that's taxable, and I believe that should have been 25, not 50 on the 89. Yeah. Let me double check my math again. Okay, yeah. Ooh. Let me go back up here and double check the standard deduction for head of household. $89.50 was correct. Okay. Second guess myself, and $89.50 was correct. Okay, no, that's right. Okay, so the taxable income is $69,350. So when I go back up here to the top, I'm going to have 10% at so much. And let's go see. So let's go back to the top. For head of household, the first 10% is $12,750. $12,750. I'm going to add that to the 15% bracket times. Let's go back and see what head of household at 15%. And I apologize that you may have to pause this right here. See it? That was at 10%. This is at 15%. So 48,600. So I'm going to put this in bracket. 48,600. I'm going to subtract that 12,750 because 12,750 of the actual taxable income was taxed at 10%. So we don't want to re-tax it. Okay, so the difference between that, we still fall into the 25% bracket. So let's go back up there and let's see what's the 25% bracket. But remember, you only made 69,350 that's taxable. Oh wow, look right here. This $125,450 fell in that taxable income. We will not write that down because you don't want him to be taxed on the amount of money that he did not make. So we're going to put bracket here 69,350, and I want to subtract that 48,600. And that tells me what portion that he made will become taxable. So now we got 0.1 times that 12,750 plus that 0.15 times the difference. Let's see, 48,600 minus 12,750, which is 35,850 plus 0.25 times 69,350 minus that 48,600. It's going to be 6930 sorry, minus 48600. That looks much better. I was gonna say that's not a really good number. So 20,750. Now let's calculate that up. So let's do our multiplication and addition. Okay, we are almost done. So what he should have paid in would be $11,840. So I'm gonna let you do this next one on your own. Remember that in this next one here, you may have to look under the married. It says they're married filing jointly, so definitely check that out with no dependents. Okay, so what do we have next? So this next example says, suppose you are in the 28% tax bracket. How much does a $1,000 tax credit save you? How much does a $1,000 charity contribution, which is tax deductible, save you? So let's think about it. The entire $1,000 tax credit is deducted from your tax bill, therefore savings you a full $1,000, right? Whether you itemize or use standard deduction. So whatever your taxable income is, it's going to turn around and subtract 1,000 right off because it's a tax credit. Okay. Next, so it reduces your taxable income. The next, when you fall into the 28% tax bracket, your best 1,000 deduction will save you. So to think about it this way. 28% times that 1,000, which is 0.28 times that 1,000 is total of $280. Okay. However, you will save this $280 only if you are itemizing the deductions. Okay, so that's talking about the charity part. This here saves you money, counts right off because it's a tax credit. However, this 1,000 charity, it's only going to save you a portion if you qualify for the itemizing. If you don't, you're going to stick with the standard and you won't use the charity. Okay. So let's talk about the next example. Our next example says, suppose you are in the 28% tax bracket and you itemize your deductions. You are trying to decide whether to rent an apartment or buy a house. The apartment rents $1,400 per month. Your investment in your loan options and have determined that if you buy the house, your monthly mortgage payment will be $1,600, of which an average of $1,250. Yeah, goes toward the interest during the first year. Compare the monthly rent to the mortgage payment. Is it cheaper to rent an apartment or to buy a house? Assume that you have enough either deductions so that you are itemizing deductions rather than taking the standard deduction. Okay, so the monthly cost of the apartment is $1,400 in rent, right? We got that. For the house, however, we must take into account the value of the mortgage deduction. So you get to deduct the monthly interest. So at the end of the year, you'll receive a tax form on how much your interest was for the year. So it said here, $1,250. If you fell into the 28% tax table, we are going to say 0.28 times at $1,250, which gives you a savings of $350. Okay, so that's how much of that money actually carries. So you can take that $1,600 minus that $350, and it's going to be $1,250 is the result of the payment minus your tax savings, right? So the fact that the mortgage payment is $200 higher than the rent, it is true cost to you is about $150 per month less than, because of the tax savings you get from the mortgage interest whenever you buy this. Okay, so that is that answer. It's just basically talking you through finding the difference. So moreover, we have assumed that you are itemizing if you total deductions are below, or, if you don't have enough to itemize, then you don't get to use your mortgage interest. So that's something else to think about. If your mortgage interest is high. However, it just because it don't help you on federal, don't mean it won't help you on state, because state has a smaller threshold on itemizing, and the standard deduction is a little bit lower. However, their tax bracket may be a little higher too. So it's just something to think about. Drew, in the next example, Drew is in the 15% margin. Marion is in the 35% margin tax bracket. They each donate $5,000 to charity. Compare the true cost of their charity donations. So what you would do is you'd take that $15,000 for Drew, or that $5,000, excuse me, times it by that 15%. That's what I'm going to say. So 5,000 times 0.15%. We're going to get $750. Okay, so on Marion, $5,000 times at 35%. So 5,000, just turn the percent into decimal. It has a savings of $1,750. So, I mean, the higher the tax bracket, the larger percentage you get, but also you have to pay more in on taxes. So that's just comparing them. Okay, so let's go to our next example. If you want to take a minute and pause this to go, excuse me, go over this in executive, excuse me, then I would do it. Moving on. My apologies, guys. Okay, so this next one said, in 2013, Jude earned $26,000 in wages and tips from her job waiting table. Calculate her FICA taxes and her total tax bill, including marginal taxes. What is her overall tax rate on her gross income, including both FICA and income tax? Assume she is single and takes a standard deduction. All right. So 2013. Say she's got the $26,000 income, right? And we're going to figure out what is the FICA. We're going to multiply this by 7.65%, which we can convert that to decimal. Gives me a total of $1,989 is what's going to have to go towards the FICA. Now we must find her income tax. We get our taxable income by subtracting the item or the exemption, right, from the $26,000. So our exemption, since she's single, is $3,900. The standard deduction for single is $6,100. So the total taxable income is $16,000. So now, when you go to the tax table, you're going to have to figure out what tax table, or what is, okay, so we know our taxable income, so we're going to go back to the tax table. So if you notice in the tax table, I'm not going to scroll back up, but we did this one ago. 10% was for single was $89.25. And we're going to add that to the 15%, which was times the 16,000, because she didn't make that full amount. And we're going to subtract the 89.25. Now let's calculate this. Oh, 16,000 minus that 89.50 is going to be 7,075. Wrote this just a little bit different, guys. So it's a total of $1,951. You always round up on the change. Or you either round. So if you got 0.10 cents, you just drop the 10 cents. If you got 0.55 cents, then that dollar goes up one. So our total income tax both. So we're going to do, I'm going to scroll down just a little bit. Our total income tax here. I'm going to write TI for that. We got the FICA plus the income tax. Okay, so what am I talking about? We already calculated the FICA of 1989. We're going to add this 19, let me see what we get again. Let me recalculate my stuff here. 0.1 times that 8925. We're adding that to 0.15 times 7075. Okay, so it's 1950. Should be 4 here because it was 1953.75 round up. All right. So now we add those two together, 1954 plus 1989. So we got 39.43. So this is what she should pay in, right? It should be on the income tax and the FICA. Now we're going to do the overall tax rate. So that's going to be the total tax divided by the gross income. So we got 39.43 divided by 26,000. So 39.43 divided by 26,000. And we're going to multiply it by 100%. We get 15.17%, which rounds to the nearest hundred or tenths, 15.2%. So the overall tax rate is about 15.2% for this person. Okay. And I feel like you could do the next one on your own. Let's look at, I'm going to scroll down just a little bit. You want to read this information and pause it. But I feel like you could do this next one on your own. I believe, hang on a second. Yeah. So you're going to just do the tax, just exactly what we did on the previous one. So you can pause it and practice it. I'll go ahead and give you the answers for them. But you go ahead and practice it. So we have a tax of 56.78, and you have the percent of 6.3. Okay, so practice that. All right, I believe we have one more to go, and let's get that knocked out of here. And you could pause this, read over that blueprint. Let's go here. Suppose you are single and have a taxable income of $65,000 and make monthly payments of $500 to a tax deferred savings plan. How does the tax defer and contributes affect your monthly take home? So we go back to that table and we find the margin that they fall in. And in this case here was the 25% margin. Okay. So each 500 contributes to tax deferred savings, therefore reduces your tax bill by a certain amount. So if they're in the 25%, we're going to take that 25%, write it in decimal, and multiply it by this 500 deferred. And when we do that, we get $125 that actually will contribute towards that. So in other words, 500 goes into your tax deferred savings account each month, but your monthly paychecks go down by $125. So you got 500 minus that 125, it's gonna go down and you're gonna get 375 and so on. Thank you.